So this is very exciting for us because I think both Rory and myself define ourselves as SaaS geeks. And when we started our journey back in 2014, SaaStr was one of the only resources on the web that we could learn what SaaS really is. Nobody knew what ARR was, what churn was, net retention, anything that seems so common these days was not obvious. And we should give a lot of credit to Jason here because you've done so much for the SaaS community, so much knowledge and expertise. And I remember Rory myself, say, "Oh, there's a new article on SaaStr. See what Jason has wrote." And really, Jason, I want to say thank you. We met before, and I said it before, but really, I want to use this platform and say thank you, not just for us as Monday, but for the whole SaaS community for your value that you created for us.
Great to hear. Thank you. Yeah, it's funny. In some ways, and we'll talk about it today, things are the same as 2014, right? But SaaS is literally, we should do the math. It's got to be 100 times bigger in terms of spend, right? Just think about, that's a decade of 20 to 30% annual growth compounding. It's just epic, right? And so in some ways things are the same, but in some ways things are so much bigger. They're so much better instrumented, right? We'll talk about, we actually know stuff now. We had to guess a little bit back then. Cohort analysis and what higher NRR really means and what CLTV means. So it's just funny how things are both radically different and the same. But yet the same, in some ways, it's the same sales and marketing motions, right? It's the same analysis. It's the same trying to figure out how far a dollar can take you. So it is interesting.
I wanted to ask you, Jason, should small startups use CAC in a different way than scale-up companies? How do you see it as an investor?
I think these metrics that we've been talking about for over a decade, CAC, CLTV, and everything, it's important to understand two things. One, they're absolutely not GAAP metrics. There is no legal definition for these things, including nor NRR, right? And I don't know how Monday does it, but I'll tell you, almost all public companies that sell to SMBs exclude their smallest customers from NRR. There's always an asterisk or a dagger. It says, does not exclude 1 or 2 seat deals, does not exclude customers that churn in the first 90 days. That's NRR. That's bad enough. But the thing about CAC and CLTV is these are sort of manufactured metrics in some way. Some come from the B2C space where performance marketing has to be really, really, really good, right? But some come from VCs who are trying to decide, and then founders as we scale, how much money should we burn, right? And so for a VC with a large fund or founders going big, right, with a large war chest, a 2-year payback, a 3-year payback sometimes is fine, right? If you're ServiceNow and you sign 5-year contracts up front, maybe there's no problem with the 3-year because all the deals are 5 years. But you can also have pretty good CAC and long CLTV and go bankrupt. This is what I see with kids these days, and I put kids in quotes. You could be 60 or a 16-year-old founder. They tell me how great their metrics are. Our CAC is so low, especially with SMBs. Our CLTV and NRR are so high, and we're almost out of money. They can take these definitions and can take you down a rat hole, and so even CAC, and is. One of the most fundamental questions for marketing spend is, do you include the free and the additional ones or just the performance marketing ones? And most marketers in SaaS will never hit their goals if you don't give them credit for the free ones, for word of mouth, because everything in marketing is expensive, right? Mm-hmm. It's so, and AdWord is so expensive. Even YouTube ads aren't, Mondays run a few, as I understand it, a few YouTube ads. An individual ad is actually cheap, but mass scale is expensive. And so if you don't let marketers sort of get credit for everything that closes versus their spend, they rarely can even afford to spend anything. So that's why these metrics, you got to measure them. You have to have consistent, but then you have to have a brain and measure them against your net burn, right? Or folks on your team will go off on crazy tangents. They'll go off on crazy tangents.
I have 2 comments on that. In terms of CAC, I think what Jason said kind of really resonates. I think there's a problem there's a problem with CAC and LTV that it doesn't measure cash flow. Sometimes you can spend a lot of money on customers and you can have a reasonable LTV, but that doesn't say how fast you actually get the cash that you spend on marketing. And the way we've measured as a company since day one, we didn't care about like GAAP return on CAC. We cared about actual cash in the bank. So how much we spend, when do we actually spend the money, and how fast we get it from customers in terms of actual collection into our bank. And I think that what made us efficient over time in terms of cash flow. And I think companies should focus more on adjusting those metrics into actual cash. So that's comment number one. My second point is that I think the SaaS community is now maturing, and companies have become more mature. Most of their S&M expense is not spent on acquiring customers. Most of what they spend on is retaining their existing ARR. So if you think about their customer success, customer support, account managers, all that expense is to retain customers, while CAC only measures how much it costs to buy a new customer. So I think that sheds just a small light into the actual expense that it costs a company to buy and retain a customer. And I think we need to mature into more advanced metrics that actually measure not just the acquiring a customer, but also how much it costs to maintain a customer.
Yep. One challenge today with being over-metriced in some ways is what I see across so many SaaS startups that I work with. And it's actually super interesting. For SaaStr itself, we have about 200 sponsors. So I get to watch what 200 CMOs and VP of field and demand gen are thinking in their brain. And what's happened is, as we've transitioned from the exuberance of 2021 to 2023, marketers in SaaS have become super short-term focused. Super short-term focus. Now, if you're Monday back in the day doing all digital, doing all YouTube AdWords, digital placements, that's fine. You actually can measure something in the funnel. And what Monday probably converts from free to paid in 60 days or less, or I'm making it up. That actually strategy works fine for a hyper SMB model. But it actually can be destructive in mid-market and enterprise. I mean, Monday's doing bigger deals today, and I bet some of those deals take a year to close, right? From initial contact to close. And so what's happened is marketers are now being judged on results this month rather than this year. And it is leading to super myopic marketing, right? Only stuff that gets me leads and even closed revenue this month. And what it's leading to, and founders should think about this, I've already seen it happen, is pipeline is drying up. Pipeline is drying up for sales teams going, hooray, you cut your marketing spend in half and you only allowed instant ROI. But if the sales team has no pipe going into the second half of the year, you're not going to hit your plan, right? So here's where metrics can also take you down the wrong hole. And we've got to find a way in the middle where marketers have some leeway to spend a budget as best they can, right? That's the tension with metrics. You have to measure it, but you also have to trust your team to say, hey, your marketing budget this year is 1 million, 5 million, 15 million, 20 million, and it's stressful, but you have to trust your marketing leadership to do the best job they can with the budget they have.
How can you reflect efforts you're doing on expanding your current user base, like expanding the number of seats of each customer? Like, is CAC serving these efforts, or should you use different ones?
I'm actually curious if Monday, as a case study, if it has a distinct customer marketing budget. This is something I talk about with every marketer. I was talking with a great SMB CMO yesterday, joining a 50 million ARR startup, later stage startup, and his number one question to me was, does this startup have a customer marketing function, right? And it actually doesn't at 50 million AR. It only has direct marketing for new business, right? And if you don't do customer marketing, you're losing out on a huge amount. But it's a complicated topic. How much money, how much budget, how much people to allocate to customer marketing?
Yeah, I'll surprise you, Jason.
Surprise me.
We're not doing it almost at all right now. It's like a huge place for us to grow into. But I'll tell you what we do.
It's a good answer. I mean,
yeah, no, it's an honest one. I'll tell you what we are doing in regard to short-term, long-term, what you talked about. So we were always like a product-led growth company. Obviously, in the beginning, we didn't have sales. And I think it made sense to be like, we had to know what each dollar is buying. We gave it like a broad attribution, but like we knew like day later what it's going to bring. Okay, like, and I'm not talking a month, like one day we gave it and did machine learning to know why, because you want to optimize the campaign. like optimizing the campaign a week later is like means you lost like 7x the money rather than a day later.
Yes.
And so that was the beginning. But afterwards, we added the sales, and things have changed dramatically. Obviously, like people, and it was mostly consulting style, but they have like a quota. Okay, so we can call them sales. But like the approach was like you already bought. The leads were paying customers, and then the sales went in an up motion and kind of helped customers. They just like called them up, helped them, and then they scaled within the organization. So what we saw, and I think in this model, which is like the majority of how we do it today, it's like bottom-up approach. You get to have both in many ways. You get to have like measurable short-term return or like results with the marketing effort you make.
Yeah.
But then, yeah, you also think long-term with the customer and help them a lot over time. And so you see those returns. And what we saw and how we do brand marketing, which we do a lot, which is billboards. We even did one Super Bowl thing, which you can't say it's like short-term ROI leads generation tool. Okay.
Not sure if we ever going to see that ROI coming back.
Measurable. Like we kind of measured, I think, like 25% out of that spent, like because we track. What we did was we track people mentioning it on calls and then saying leads being closed and deals being closed, and kind of attribute it that way. But the point is that we kind of allocate more or less around like 10-15% of our budget to doing other stuff because we understand it's important. Like not short term and those kind of thing. And even within the performance marketing, we have a test budget and we have the team running on various stuff because we want them to be creative. We want them to do other things and sometimes figure exactly how to measure them after we do some things.
Yeah, if nothing else, I think for founders, if nothing else, reflect on this customer marketing. It's so interesting that Monday, with its incredible success, does not have a customer marketing function. But again, I was just talking yesterday
we're not spending a lot of money on it.
Yeah, but here's an interesting. I track this with SaaS companies, and it's a niche metric, but it's super interesting in terms of long-term health, which is the ratio of revenue growth to new customer growth on a percentage basis. So I like to see at least sort of a 2-to-1 ratio. Like if you're growing 50%, I like to see you adding at least 25% new customers. If you're growing 50%, you're adding 10% new customer, you're fatiguing your base, aren't you? When things are stressful, like they've been the last 12 months, you've seen these ratios get inverted, even in public companies where the new logos aren't there, and you see much more than a 2-to-1 ratio for revenue and new logo, and you're sort of 2 parts of that. One, if you do see that, you're overstressing your base. 2, if you think about it existentially, your marketing budget should be roughly related to that. How much of my revenue am I getting from growth in my base? How much am I getting from new customers? No one gets it right. No one gets it right in sales, and no one gets it right in marketing. And but if you can just put a little more of that budget into growth, right, versus new acquisition, magic can happen, right? Just a little bit. You at least want to make sure you're not stressing your base. Too much of that has happened the last year.
Yeah, I totally agree, and I think that companies that have both enterprise and able to acquire new SMBs, that's the holy grail. Those SMBs will become the enterprises of the future at some point. And something that was surprising, I would say, in the last 12 months since the economy changed, is that we actually found that our SMB budget was more stable than our enterprise segment. So the SMB's NRR, was actually more stable. I think a lot of enterprise companies have reduced, stopped hiring or reduced budget, while SMBs continue to kind of be very stable. So I think that having both really contributes to the just reducing the volatility of the business.
Yeah, just to emphasize what you said, the enterprise growth is still much higher. It's just more stable, the SMBs.
Yeah. It is interesting. Trying to figure out what's going on with the global economy is confusing. And that SMB, it's interesting because if you look at the U.S. in particular, we've got 3% unemployment, right, and still a pretty profoundly, strongly growing economy, yet massive stress at the CIO level and in the enterprise, right, and restaurants and small businesses, and many of them, auto repair shops, they're at maximum capacity. They should be buying more software than ever, right? And yet enterprises are all cutting the number of vendors, trying to hold the line on budget. It's a strange world. It is interesting that you see that stability for SMBs. I think we should be seeing it, but we're not seeing it across all companies, right? We're not seeing it across all companies.
Okay, I want to move on to the next metric because we do have a lot to cover, and I want to talk about ARR, which kind of started out as a well-defined metric, and then it became something pretty fluid between companies. So I wanted to hear, Jason, your perspective on, should all SaaS companies measure ARR? What changed since we started using it?
Well, look, I think we could probably all agree that, and this has happened even with terms like cloud or SaaS. It's gotten corrupted over the years, right? And so ARR used to stand for annualized recurring revenue. And then fintech exploded, and so they all wanted to claim they had ARR, even if a lot of fintech revenue is not recurring, right? Not all Stripe payments are recurring. Banking as a service is not recurring, but they still all claim they had ARR, right? So we had that issue. And then it wasn't, nowhere in that ARR was the word SaaS or software, but it should have been. Because the other thing that happened is hybrid models that are services and software, models that are hardware and software, all started to claim it was ARR, right? And I wrote up today on the SaaStr blog, if folks want to look, Matterport. I don't know if you ever use Matterport. It's like that cool 3D software where you can walk through houses and buildings. It's like super cool, but half their revenue is from services and cameras, so their gross margins are in the 40s. Right, I think Monday approaches 80, right? Or there's some loose definitions of gross margin, but that's dramatically different margins than Monday, which is a software company, and 80 Matterport, which is super cool, right? I mean, software is hard enough to build. Imagine adding cameras and 3D. That's harder than software. But the margins are in the 40s, and for a while it didn't seem to matter. Twilio was valued the same multiple as a pure play software company, even with lower multiples. Others were. And now we're in this world where, in this new world today, there is a large discount if your gross margins are lower, right? Mm-hmm. And VCs got drunk, and VCs funded all revenue the same, right? And there's many. I'm going to guess that the most unicorns that go bankrupt in SaaS are folks that are hybrid models, that are services, that are other things, or that are non-recurring revenue, right? If you're Better.com and you sold mortgages at the peak, and now there's no mortgages because in the US it's 7%, that was never SaaS, right? It was never ARR. So my rambly point is, now you are who you are. Matterport isn't going to stop doing 3D tours or stop having cameras, but you have to, and they're very honest about it in their public filings. You have to be religious as a founder. Segment your business. This is software, this is services, this is payments, right? Especially payments, and be honest about the margins, because just like CAC and CLTV can kill you, low margins can kill you. Like, there's so many pseudo SaaS companies that have much lower margins than 70%. And as religious as Monday was in the early days, right? With it, you have to be even more instrumented and careful when you have real costs, right? When your gross margins are below 60, mm-hmm. You have to be super careful. And people got sloppy. They got sloppy.
Yeah, I think this is a great point. I think my analysis of what happened was that, founders have noticed that you get a great multiple for ARR as a SaaS company, because it comes with all the benefits, stability, revenue growth, and so on. So everything was marketed and packaged as ARR, consumption and usage. But there's a huge difference, because consumption changes. Suddenly it's the holidays and you get more server load. Suddenly you get less billings. And the point about ARR, it should be stable. It shouldn't be based on any time of year. It shouldn't be based on usage. And I think that was unfortunate. And I think even for SaaS companies, there's so much nuance. Do you include discounts or don't? If you have upgrade and renewal? Is it the ARR, or do you not include it? There's so much nuance. And maybe going forward, as the industry matures, there might be like gap rules for what is actually ARR.
Yeah. At least realize that if you're not pure software, you're playing by a tougher set of rules nowadays, right? And as Eran said, it got masked in the boom. Everything got called ARR, and no one looked under the hood. No one cared if the top line growth was there. No one cared.
And the funny thing is, once you have ARR, you also have NDR. So if it's ARR based on consumption, suddenly you have NDR of 180, 200%, and it just doesn't make sense.
Yeah, my rule is if your ARR ever goes down, it's not ARR. ARR may grow slowly or more quickly, but when you see a startup where the ARR has gone up and down, I'm like, okay, I got to dig in here, because whatever it is, it ain't ARR, right? It just doesn't happen that way.
Yeah, it should be stable. That's the point.
But it is interesting in the world today, and actually I should know. I don't know. Does Monday do payments at all? Is it added payments to the platform yet? I mean, everyone under the sun pretty much has, haven't they? They've added payments in some fashion, right? But the models are evolving, right? And for example, Bill.com as an SMB hero was a pretty good company before it had payments when it IPO'd. Now it's an epic company at 15 billion, but the majority of its revenue is actually from high margin payments, not low margin, right? It was $1 billion company to 15 by adding payments. Shopify, margins aren't perfect, but the majority of Shopify's revenues are payments, right? If Shopify was just a SaaS company, it would be a fraction of the Shopify we know. So there's all these hybrid models that are going to happen. It's just, we've got to be more honest as founders about what is ARR and segmented. And I'll be direct. I would say the two worst investments I've made, and I haven't made very many bad investments, but as time went on, I made more bad investments, not less, because we kind of let the bar expanded the box. Those were folks that claimed stuff was ARR that wasn't. They saw either massive churn or issues with their burn rate or other things, and I call it pseudo ARR, right? All these problems are coming home to roost. So if it's you, just be hyper aware and honest and transparent about what your sources and quality of revenue are, because you may fool a few people in the early days, right? But it will bite you later. You can't hide from low gross margins. You can't hide from these issues. So too many games. There's every VC has a Theranos or two in their portfolio, or an FTX. It's not just FTX. They're all over the place. And one of the great frauds was manipulating ARR in 2021. There were a ton of startups that lied about their ARR.
I got to follow up on this, Jason. What about the other side of the spectrum? What about companies that might sign a contract for 4 or 5 years? When does ARR become perpetual license?
Well, in what's the question behind the question? Everyone would love, in an ideal world, if Monday could close a customer in 24 hours that would do a 5-year contract, you'd probably take it, right? There's obviously a trade-off between time and long contracts.
Sure. I'm not sure, because I'll tell you what, you become blind to what the customer wants.
Well, you do. It has a downside, right? You become less customer-centric when you can phone it in, right?
Yeah, I think one thing that the SaaS industry has created is alignment between the customer and the software company. So the customer can always kind of make a decision to leave the platform, and you keep improving it as you want to retain the customers. And let's say you in a hypergrowth and sign a lot of revenue into 2 or 3 year contract. You might find out in 3 years that you have a huge churn wave coming up that you didn't predict.
Well, 2 thoughts on that. First of all, years ago, in the earlier days of SaaStr, we did an event at Cornerstone On Demand's headquarters in Santa Monica, and the CEO was there at the time. And he said something at the time I thought was crazy, but I know you guys will actually agree with this, which is I forced my team to only do 1-year deals. And Cornerstone was more enterprise. It's enterprise learning management system, and you could easily work your way to a 3-year deal for an enterprise purchase like Cornerstone On Demand. He's like, no, it kept us honest. It made sure we didn't do terrible deals, junk deals. We were honest. I did not want even 2-year deals, and I was much closer to being a SaaS founder than I am today. I thought, hey, that's almost dumb. I didn't say it that way. I said, that's great. But he's right? He's right. And the other thing I'll say, Eran, I'm going to challenge you. I think that in a good way, I think companies like Monday and Shopify and folks like that are constantly challenged, right? Because you can leave anytime, right? But I will say across the spectrum of SaaS companies, I see the opposite. I see much worse behavior the last year and a half. I see threats constantly from customer success teams threatening folks to leave. I wrote this up. I never name names, but a leading SaaS company that is SMB sent us a bill where they quintupled our annual bill and told us we had to pay for 4 years up front. So 4 times 5 is 20. Wow. They sent us a 20x bill. And this is a leading public company where growth has slowed a lot, right? Monday's growth is, maybe it's slowed a little bit. It's pretty good, okay? But folks have been under a lot of pressure. And there's a lot of shenanigans, a lot of borderline unethical ways price increases have been done because, look, you got to be not being non-transparent, hiding things, because if you own the customer's structured data, it's hard to leave. It's hard. Monday's a CRM and many other tools. Sure, you can leave. There's a million other tools. But can I really export all of my data and immediately get it fully structured in a competitor? I'm not so sure, right? Maybe you can tell me, right? So there's always some data lock, right? And I've actually seen worse behavior I've never seen the last year as growth is slow. Just pressure on like we talked about, too much pressure on the base when the new logos aren't growing.
It's a good point on retention or stickiness. We actually, since day one, aimed that Monday will be at the core of operation of every team. Okay? Yeah. Like we didn't want to be the ones who get chucked out. That's why you see the stability now with SMBs. Yeah. Because they rely on us more. They consolidate on us because they run their operations. So I think we're super sticky in some areas. But regardless of that, when the economic crisis happened, like we kind of took the opposite approach. We said we want to be a great partner for our customers. We kind of like took the approach of like extending their ability to pay and a lot of other things towards customers rather than doing the reverse. Yeah. In many ways. And so like I think that's like a more of a long-term decision, and I think it pays off once you think perpetual, you think recurring, and you don't think short-term, because every quarter is going to end, like 2 years ahead, it's going to reach us.
Yes.
So we need to think like strategically with every customer.
Yeah, we need a metric in 2023 that, if we're talking about metrics, we need a metric that only founders can own. And it's customer-centricity. We need to know how customer-centric the company is, because you can brute force high NRR with longer term deals. You can brute force NRR if you threaten customers when they leave with an inability to get their data. You can brute force NRR by having out of bound price increases, 30 or 40% a year. One vendor we have, we're their largest customer, they raised prices on us 40% a year and didn't add a feature last year. I asked them why they did it. And they said, because we need the revenue. I'm like, that's not my problem. Like, I'm trying to learn, I'm SaaStr. I'm like, that's a very honest answer, and I do appreciate it, but you haven't earned that business. You didn't ship a single feature that I've used in the last year. We've asked for like 100. We're your single largest customer. We've gotten none, and you raised my prices 40%. And so there's so much pressure to do these things. And if the CEOs don't make sure that your customer centricity isn't staying high, bad behavior can slip in when there's growth pressure. Right? Yeah. When there's growth pressure.
I can share our metric, like our top line metric, and the one we kind of like, I think after like a few years, we kind of went to that from new paying customers to WAP, weekly active paying people. Yeah. So we cared, like we said, we don't want to learn about a customer problem when they churn or not. Like we don't want to see the revenue because that's too late. We want to see them churn when they use us less. We want them to use us more and more, and we actually measure that, but it's a top-line metric. It's really hard to move on an A/B test. So like we had to find proxies and a lot of other metrics to kind of help improve that. And it's still like that today. Like we measure activity.
Maybe one last question before we move into to the next metric. Jason, you talked about customer centricity and using other metrics to support ARR. Do you think it should become a standard for public companies, to put it in their F1? What should they do to reflect this customer centricity? To reflect?
I don't know. For years, people have been saying the problem with going public is it forces you to be too short term, right? And the reality is there's truth to that, right? The reality is, yeah, Jeff Bezos convinced the world you can go long on investing, right, on the top line. But even there, he still had to hit the metrics, right? And so this is the existential challenge for founders. And I think it gets harder as you approach and then become public, is staying super customer centric, because, you know, you'll get, whether you're bootstrap, venture backed, or public, the later stage you get, the more pressure you're going to get to hit every quarter and every month. And with startups, for example, if you're venture backed, let's say you just raised a round, you've got 5 years of revenue, you have a soft quarter, the VCs are going to be like, okay, buck up, Roy and Eran. Like, things are pretty good. You know, everyone has a rough quarter. You know, it happens to you as a public company. It's a sucker punch. Even though you tell the team to be calm, it's just a quarter. Everyone feels it. So this is I think this is what we've learned the last year and a half in SaaS when we went into a tougher, I'm not going to call it a downturn, because buying's up. Buying is not down, buying is up. But as it's tougher, is founders just have to own this. And I don't know that it's a public company metric, but it's the secret founder metric, whether it's WAP or WAD or whatever you use. But it's too easy to let customer happiness just drop. It's too easy. It just, because it takes some stress out of the system in the short term, right? The classic one is always when, for example, someone on the revenue side wants to shorten the free trial. This is the classic one from the beginning of the internet, right? Someone comes in and they're like, oh, we have a 30-day free trial. Like, I'm going to switch this to 14 because, you know, we have too many free riders and we'll convert quickly. And there's always either some data or a spreadsheet that says that's a good idea. And sometimes the startups just say, pause, maybe we need a 60-day free trial. Maybe, I mean, I don't know what Monday is or all of it.
We've done the same thing.
30,
from 30 to 14. Yeah.
Okay, you did the classic 30 to 14.
Yeah.
Okay.
And I'll tell you why.
Yeah, why?
So we'll have a shorter input cycle towards media buying. Like, you know, we were really religious about.
But are you sure it's better for the customers that it's shorter? Are you sure it's better for the customers?
It didn't change the metrics. Like, really didn't change the metrics.
But are you sure? Look, it's hard to argue with Monday because it's so successful. But are you sure it's better? Right? Because this is where the metrics can confuse you, talking about metrics, right?
Back in the day, you know, we were not testing it every day, but like back then we did a very long term A/B test, and it didn't really move the metrics towards paying customers.
I think it depends on the product. If it requires longer implementation or like a professional to help you on board, then maybe it makes sense to do like a long trial. But for us, it was very easy to get set up and get value from the beginning.
No, for sure. It's just something founders need. I'll give you a couple personal examples. Back in the day, in the early days of Adobe Sign, EchoSign, where we had a truly viral product, DocuSign, Adobe Sign, these are very viral products. I measured in the early days how long it would take someone that first got a contract to sign to convert to paid. Okay. First, they'd have to decide to sign up themselves. Then they'd have to try it. Then they'd have to do it. Then they might need to get 3 or 4 exposures in the wild, like marketing, right? It was 8 months. It was 8 months. Okay. Not 8 months from someone doing a search for e-signature or something and finding you and buying. That was 14 days. But the true viral conversion coefficient was real. It was profound and it was slow. And no one cared except me, right? 8 months is too long. No one cared. And when almost a week after I left, after acquisition, that got ripped out of the product, the whole free thing, the whole free conversion. And because it didn't help anyone there. But then over the next 3 years, there may be a variety of reasons, market share fell by 50%. So these as founders
those
are things
compound,
Yeah, and there was no one left at me, even though the business is doing, what, 250 million today, there's no one there left to be the champion of the free, the champion of the long cycle, the champion of the meta metric, the champion of the founder metrics, because it said to one of the most successful companies on planet Earth in software, hey, get rid of this. Like, there's no data, it's 8 months, we're not gonna make the quarter, right? But it was wrong from the generational perspective, right? We lost half the market share.
I'll tell you, like, our approach growing up as a company was that I always believe there is like a lot of ways to do things.
Yeah.
And like, why not pick the one that we have data or quick data on the path? You know, that's what we aim for all the time.
Yes.
And so, like, arguably there are like hundreds better ways to do it, but we just don't know, and we probably would have known. Like it happened to you, that if you don't have the data, if it takes you like 8 months to get the data and maturity of it, like maybe like, I don't know, 10 months, okay?
Yes.
Then it's very slow to make decisions. If you have to iterate on that all the time. And so like we kind of opted for the, shorter term, like, and I don't know how to do things on such a long term. It's very hard.
Monday is wildly successful, so I can't be critical, but it's just interesting to think you could always be more successful. There's no question, even any company could be 5 to 10% more successful. And over a decade, that compounds to an awesome rate, right? That incremental piece. That's almost the existential. It's almost fun in a way. It's what SaaStr is about, is how can you be 5 to 10% better at everything, do 10 of those, and you change the course or trajectory of a company, right?
I agree. Yeah.
The related one, just Daria, what I think is super interesting on these metrics that has changed the last 2 years, going to this point of what do founders need to own, is NRR versus CSAT or NRR versus NPS. And when we started with SaaStr, I was kind of anti-NPS because it seemed like a big company metric, but then we learned it kind of works, like as a consistent way to measure things. You can use CSAT, you can use NPS. They're not the same, but you can game them, and you can game the question you ask, and you can bribe people. But if you do it the same way every month and every quarter, and you track it over time, you can see trends. If it's better, it's good, and if it's worse, it's bad. What has happened in the last year and a half is it has been abandoned by most startups. In favor of maximizing NRR, right? And as a CEO, you have to be the boss as founders of this trade-off of, again, NRR versus CSAT. You have to get the data, and if your CSAT or NPS is declining and your NRR is growing, you've got to jump in, because no one in your team is going to jump in. This is something I hadn't seen ever in my history of SaaS, but I see it all over the place now. Is CSAT, NPS down, but NRR up? This is a reaction to stress.
Yeah, just like why do you think is the reason? Because they don't necessarily have to, they can go together.
Yes.
These metrics.
Well, let's give an extreme example. Let's say I'm Salesforce, okay? So Salesforce is growing organically, I think like 15, 16%, something like. I'm making that up, but it's like in the high teens. They just raised prices 7% yesterday. So you know what? Their NRR is going to be great.
Satisfaction is down. Yeah.
NRR is going to be great. I'm not saying satisfaction is going to be down, but they can hide for a year if they want. Mark's pretty good, but they can hide for a year in that price increase. When you're going 15%, if 7% gets you to 22% growth, right? I'm simplifying complex math. Yeah. Like you've hit the plan for the year with one quick reconfiguration thing to your. But going to Ron's point, if the customers are getting less happy behind the scenes, like you're sacrificing here, right? You're sacrificing here, even if the team may hit their numbers.
Yeah, I totally agree. I think that getting more dollars from each user doesn't mean that they're more happy with your product. And I think that's part of the thing that I actually have a question, Jason, because we had a lot of conversation with investors throughout the years about both net retention and gross retention. So first of all, I would love to know, what do you think about both? Like, when you see a company, do you look more on the NDR or gross retention? Like, what are the red flags that you kind of look for, and which one matters more? And what difference between NDR from an enterprise-focused company to an SMB-focused company?
And also, Jason, maybe just in a sentence, explain the difference between NDR and gross retention. Yeah,
it's a great question. And gross retention is what % of your revenue or logos are you retaining without upsells, stripping out upsells? Just what % of your existing base or your existing logos are you retaining, period? And when we all started in SaaS, it took us a while to even understand that NRR was this profound metric, right? And it's so profound. Monday selling to SMBs having triple-digit NRR is so profound. It's so profound on a spreadsheet, right? And so it took us all a while. By the way,
Jason, I don't want to interrupt, but it's a great point because it's one of the only SaaS metrics that all SaaS companies report. Not ARR, not CAC, but NRR. Almost all SaaS companies are reporting NRR. Yeah.
Yes. So when SaaS started to take off, we realized that was our holy grail. In fact, the first SaaStr post ever was it was called "It Compounds," basically, and it was all because it was magical to folks in 2012 how this worked, right? And it went like viral, and Aaron Levy reposted it, and David Sachs and everyone, because it was like an epiphany that now I mean, this is as fundamentally basic as it gets. And then I remember maybe in 2019 I was doing an interview with Kyle Porter, who's CEO at SalesLoft, which got bought for $2.5 billion. And they had crossed 9 figures of revenue, and they were sort of early getting ready to go public, right? At 100 million plus, hired the CFO. And he's like, the biggest change is everything's about GRR, not NRR now. Now, we haven't seen that show up in the public companies, right? But his point, it was an epiphany for me. And I'm like, you're right. At the end of the day, the metric everyone's going to talk about is NRR, going to Eran's point. Every public company reports it, but GRR is more important. GRR is more important. If Monday is able to, I don't know what Monday's logo retention is, there's a different way to calculate it. But if you sell to SMBs and you have 90% plus logo retention, you're off the charts good, right? You're off the charts good. And it is harder to hide games here. It is harder to hide issues, and it is harder to hide price increases and rip off deals and things when you aim for top decile logo retention and GRR. Yeah,
well, unless you sign a 3-year contract.
Yeah. We have to talk about that. Like,
yeah.
So I would try and say that like gross retention has to be stable. That's important.
Yeah. It's a good insight. It's got to be stable, at least stable, right?
But the number of it varies, because if you're like, I'll give you some examples to cheat. Like one thing Eran said, if you have like 3-year contracts. Yeah. So like we saw some companies with like 97% gross retention.
Yes.
And they raised money as like crazy valuation, and then they crashed because they, it was, they didn't see the churn.
Yes.
One way to hide it, like long
for sure. And almost, and Monday would be a great one. Almost, if we had more time, one of the most important things I can say for all of these metrics is you have to segment them. This is what too many founders don't do. You don't segment them. Like, unless all your customers are truly homogeneous, the same, always segment small, medium, and large, or at least small and bigger. Always segment, because there's always at least 2 to 3 trends in your base, right? And for GRR, you might see, 75, 85, 95. Like, for example, that's what you could see. ServiceNow approaches 100%, right? 5-year contracts can never leave, right? Their GRR approaches 100. 75% might be pretty darn good for small businesses. In fact, it might even be unachievable for one-person shops, right? But you got to segment it, or you will miss the trends in the base, right?
I think that's a great point. I think that's, SMBs, just by the nature of being SMBs, are more likely to churn just because going out of business. But they might have great NDR, where enterprises, once you get a software inside an enterprise, even if they're not using it, it's going to take a while before they leave. So just by the selling to different sectors and segmenting your customers, you can do different measurements of gross retention and both NDR and get different results.
Yeah, I'll give you just one story. There's a SaaS company I've worked at, invested in, that's coming up on 40 million ARR. So pretty getting mature, very SMB, probably similar to Monday. And all the other investors were complaining that their NRR was only 90%. Like, you guys, if you don't get to 100, you're just not going to make it, right? And and I'm like, okay, that's right, that's true. And like, I kept telling them, these guys are so smart, but I kept telling them, segment it. And they have a lot of single seat customers, one user, right? And when they finally segmented it and you take out the single user, it was north of 100 from 3K ACV. Like, you guys are like 2K. Like, it's almost impossible to have 100%. And they did it. They went from bottom quartile to top quartile by segmenting.
That's exactly what happened to us in one of the rounds. Because we were at exactly the same thing. It was a 90, and we didn't know until we figure out to segment it, and then we saw the difference.
Yeah, and it's interesting. This company I'm talking about is also one of the best instrumented in analytics, but like you guys, but they just didn't do it, right? Just like you did, you gotta, and it just, I kept breaking, like month after month. I'm like, I think your NRR might be better than you think. It doesn't feel right given your market position. But okay. And you got to segment it. And you got to segment how you attack your market. It helps with marketing. It helps with, you got to segment your sales team as early as you can and your customer success teams. And folks, actually, I find, and I'm not sure why, but it's interesting, Roy, what you said. I actually find founders and startup and SaaS companies segment later these days than they used to. They do it later. They're breaking their sales teams up into small, medium, and large. They're breaking their marketing spend up, their CS teams up later, 30, 40, 50 million. And we used to do, in the old days, we would do this at a couple million in revenue. We'd be like, we have no choice. Like every lead was so precious. The markets were so small that you immediately realized specialization would help. Let's put Eran on the 5K deals and Roy on the 3K deals and Daria on the 10K deals. And but now I actually see it happening later and later. But I actually think it always works. It always works in the metrics and with teams. You always get a boost when you segment your teams and your data, right? You always get a boost.
I think another insight that I can share is that companies are always looking to increase their NDR. And often the way you think about it is, we need to improve the product. That's always kind of how you think about it. We need to improve the product. And that's obvious, like you need to improve the product. But I think another thing you should do is to create upsell opportunities, because if you don't have upsell opportunities, you won't be able to increase the contract price. So, for example, Monday we have is seat based. So the more people the company hires, the more seats we have, the more we expand. But we have an option to add more layers, more add-ons, more features that we can upsell to customers. So I think that's another way to think about how can we add more value to customers, how can we offer more upsell opportunities. And that's a great way to think about how can we increase our NDR going forward.
It is just two thoughts on that. One, going to Eran's point of why every public company reports NRR for founders. As you scale, as you approach later stage, this is the most important metric to investors. Whether it should be, we could debate it a little bit, right? Obviously, mathematically it is, but you will get incessant questions as you approach 30, 40, 50 million and beyond. It'll be the number one question both private and public customers will ask they have become obsessed with the annuity factor of SaaS. So, understand it, segment it, obsess about it. And then the related point is, there may be an exception or two out there, but from my knowledge, for folks that sell to SMBs, I do not believe anyone got past 100 that is single product, right? And HubSpot's the biggest example. HubSpot was stuck at 85% through 40 or 50 million, and they really never got past 100 until they added CRM and service to the piece. They just had to be multi-product, going to Eran's point. And we could talk about why, but it's a fact of life, right? And I don't think Shopify got there without payments. We could debate whether that's multi-product, but it probably is. But so you've got to figure out that strategy. If for no other, TAM is a big reason, but you'll never get that stickiness without the second, third, fourth, fifth product to add, right?
I can share. We had a problem with that, with explaining it to investors, because we grew too fast. And when you have new cohorts, that they're not yet mature, it obscures everything. When you're cohorts from the new year kind of obscures all the rest, and everything kind of looks weird, like you said. And we had to work so hard to show that. Even on the graph, when we did the graph, it looked weird, because all the small cohort looked flat. Physically, when you looked at the graph, they looked flat. Only when you removed the new cohorts, which were bigger, you saw the same image of exponential growth. So it looks like, hey, all these cohorts are flat. Why are they flat? They're not flat. You just can't see it because the new ones are 3 times bigger. So we did an animation in the IPO. We created an animation that we added the layers, and everyone saw it's the same thing, because no one understood it's exponential when it appears flattish because you're growing so fast. And other companies, when you're not growing as fast, when you're adding the same number of customers over the years, then you have it looks very healthy, like a layer cake that you can compare one to the other.
Jason, I just want to add, I think something you said is really profound, and I want to share my perspective as a founder. When you start the journey, you mentioned that NDR is one of the most important metrics as you grow as a SaaS company for investors. And now I have a deep understanding of why, because I think when you start the journey, especially in the few first years, you're just focused on acquiring new customers and growing business. But eventually, as you mature as a SaaS company, the majority of your revenue, majority of subscription is actually coming from existing customers, even to a point where it's 95%, 98% of the revenue is from existing customers. Some of them might be more than a year, some of them might be 5-year-old. So when you reach that point, NDR basically represents your growth rate. If you got 130% NDR and 95% of your revenue is coming from existing customers, your revenue is going to be about 30%, just the law of nature. Your new customer is going to add to that, but eventually the company will converge into its NDR in terms of growth rate. And yes, you add other engines into the mix.
Yeah, I remember when I joined Adobe, we were trying to merge our Salesforce instances. And I said, well, where are the opportunities? Where are the leads, contacts, and opportunities? They're like, well, everyone's an Adobe customer on planet Earth. We don't have opportunities. We just have upsell. And they didn't call them upsell, going to your point, but they had a different term for like the size of the potential account and how much had been accommodated. But there literally was no need for lead, contact, or opportunities because there was not a single sizable account that at some level wasn't an Adobe customer. It was my opening mind to the NRR at its extreme, right? It's extreme, which is there's nothing to do but maximize accounts. I'm sure it's true at Microsoft too, right? I mean, we can, or Google. I mean, everyone at some level is a customer, right?
Okay, guys, we have just a few more minutes left, and I want to still talk about one more topic, which is one major gap that I think we haven't talked about yet, which is how to measure, cash flow and path to profitability. So, Jason, I wanted to hear your take on that.
Yeah, maybe how do you optimize for it? I think because we know how to measure free cash flow, but as a SaaS founder, any tips or recommendation?
Yeah, let me. You guys might have even read this post in the early days. Maybe it was after you took off, but I try to update this every year because I'm shocked at how few founders do this. It is my number one tip. It always works. It always works. You have to constantly every month do an L4M analysis. Okay, you do not need 20 people in finance or operations or planning to do this. Any founder can do this. Take your financials, and all you need is your top line and your bottom line, how much your revenue grew and how much you burned. You don't need anything else. Average the growth rates of both, the growth rate of your top line and the growth rate of your burn rate for the last 4 months, and just roll it forward. Roll it forward 12, 18, 24 months. That should be your real operating plan. Okay, no matter what anybody tells you, no matter what anybody says. And if that says you're going to run out of money in 12 months, you're going to run out of money in 12 months. Okay, it doesn't matter what your ops person says or your VC or finance person. The accuracy of an L4M model is so high, right? It is so high, even at the earliest stages. Does it become inaccurate 5 years out? Potentially, right? But if you're growing 6% the last 4 months, but you really want to grow 12, and your dumb model for the VC says 12, well, tough, okay? The L4M model says 6. And if you, every month you say, well, our burn should be 200K, but hey, we had these legal expenses, and hey, we did this deal, and we did, so yeah, it was 400, 500, 400, but it's gonna be 200 eventually. The L4 model doesn't care. It doesn't care about what your excuses are. It doesn't care why you missed the month. It doesn't care if the deal slipped a quarter. It just doesn't care. And when I invest, when I work with founders, when I do anything, no matter what they say, I just take their financials and roll it into an L4M model. It's always correct. It's always more correct than what they say. And what I love to keep you rigorous is every month on the first of the month, because it should take you like 15 minutes if you can understand what I'm doing, redo it and either share it to the whole company or share it to the senior team. This is what the numbers say. Okay, I know we want to grow 100% this year, but since last month it was only 3%. This is how it ripples through our L4M model, right? This is how the burn rate, and you don't even need to know anything. You don't need to know head count, schmed count, CAC, SMAC, CLTV. This L4M model is your best tool as a founder. It's never wrong, and you may not like what it says. I find many founders the first time they do it, they get a little prickly. They're like, no, we're going to triple this year, Eran. No, Roy, we're not going to burn that much. But as the L4M model automatically updates it, right? It's just average your last 4 months of your top line growth and your burn rate and roll it forward. It is better than the most expensive CFA, CPA, CFO, multi-million-dollar team. It's better than all of them. I bet it even works on Monday today. If I took up your financials, I think I only get quarterly, but if I had the monthlies and I just rolled them forward, they'd be pretty darn accurate.
I think it'll work better today than it did when
Yeah.
Yeah, maybe, right?
I was about to
What
say,
I can tell you from experience is it absolutely works at $1 million in ARR. Like it works at $500,000 in ARR. It always works, right? And this 4 months is just perfect because it gives you that extra month to take out the variability, right? It gives you that it turns out it's the perfect amount, right? Even if you're public, it probably gives you, it straddles a quarter, right? It probably gives you that extra little, it takes a game out of the system. But it's interesting to work better, but trust me, just do it now. And if you don't like the conclusions, then make the changes. You're going to run out of money. You talked about cash flow. Forget about all the other metrics. They don't matter. What matters is how much cash have you been burning the last 4 months? And if you don't make any changes, if it's growing, if that burn rate's growing 3% a month, it's going to keep growing. This is the mistake so many founders make, especially if they de-bootstrap. This is the number one. Another bit of advice I can give to folks that de-bootstrap. A lot of folks that listen to this may de-bootstrap, right? It's not being venture backed or not being venture backed. A lot of folks will either be forced to. Ventures, it's hard to get venture capital. You guys had to raise it at 3.5 pre. Like, it's hard. And so many folks will wait until 1 million, 2 million, 10 million, 20 million in ARR, right? But the mistake I see again and again is if they de-bootstrap post-revenue but pre-scale, is their intuition's wrong. And they burn up all the money. Like, okay, they don't get the fancy office. They let Roy and Eran have 2 more hires instead of 1 each month. But it's kind of the same. The sales comp plan doesn't go crazy. They're like, my gut is that's fine. And then 12 months later, half the money's gone. But if they did this L4M model, it wouldn't happen. They would see this creeping up on them in real time.
So I have like a motivational tip that we did, and a lot of people loved it. We kind of, when we were in one room office back in the day, I kind of wrote on an A4 paper and stuck it on the door, like, do you want to live forever? How much customers do we need to get so we can live forever and not burn money on the current burn rate we had? So it's like the same thing you said. Like, I completely agree, just with the motivational approach to like where we do need to reach to meet the goals we set.
Yeah, and Dario, just to finish up the point, the advice on the burn rate going to this, the flip side of the L4M model is the biggest danger I see with founders is they get a crap model from their finance team. I see this all the time. It's the worst of all mistake is a lot of founders these days wait to hire a VP of finance or director of finance, let alone a CFO. Instead, they hire a director of operations, some smart kid from McKinsey or something like that that's whip smart. And they're like, I don't want a bean counter. I don't want an account. I want this guy that spreadsheet jockey, right? They can do it perfectly. And the problem with the spreadsheet jockey is if he doesn't like they manipulate the inputs. Like if Monday.com goes and gives McKinsey $10 million to plan the future of their company, and then Roy and Eran don't like it, McKinsey goes back and just changes the variables. They just change the variables. And so these director of ops, I see it again and again. And if you peer behind, you know what the model always looks like? In Q1, we'll do 2 million. Q2 will do 2 million. Q3 will do 4 million. Q4 will do 18 million. Like they're just manipulating the model. And not only do they blow the top line, but they blow the cash. They blow the cash. And I see too many founders who just trust their director of ops, the McKinsey kid, and they blow all the money. You've got to do it yourself. Like the models are terrible. They're terrible. And they put in assumptions that make sense for wildly profitable companies that have a margin for error that startups don't have. They're all terrible. I can tell you all the models. Very few people can update a dynamic model every month and predict your cash flow. You got to do it, right?
You made Eran laugh. It's like
It sounds so familiar. Yeah.
Be careful. Those guys can help you model your business, new product expansion, new NR. They're really good, these McKinsey folks, but they're awful at projecting your cash flow and your cash.
You know what they say? An Excel sheet can absorb anything. That's always true. You can write whatever you want in Excel.
Yeah.
A tip for life. I know we have to end, so maybe just each one of you, if you have, any one takeaway that you want founders to take from this conversation. One good tip, Jason. Maybe we'll start with you.
I think my biggest tip is it is go long. Roy touched on this a little bit. Go and decide how long you want to go. If you have a good look, we're looking at two great co-founders here. Okay, two co-founders is pretty special. It's what I look for. If you have two co-founders, if you're Roy and Eran or better, then be honest and decide how long you want to commit for. If you're willing to commit for a decade in the beginning and 20 years as you go in, then you'll get through all this stuff, right? And you'll make the right decisions and you'll recruit the right people. If you're willing to commit for 1 year or 2 years, which is pretty common, you're going to have a very different outcome and different path. And I don't mean to be critical of it, because 99.9% of people should not commit for 20 years, right? It is no matter what you see on the internet. But be honest, be self-aware of that to founders. And that's if you have 120% NRR and you have great founders, you can go as long as you want in this world. No one can stop you if you have high NRR and great founders. That's my last tip. It's up to you. Now, maybe hard, and I'll give you a last tip. I have the last investment of a batch I made in 2015 has been around for 20 years. Now, I didn't invest 20 years ago, okay? I invested late, it de-bootstrapped. And they are now selling for many hundreds of millions of dollars. Not billions, but many hundreds of millions of dollars. They just never quit. They never quit. And there's so many stories like this of founders that want to do it, and they had higher NRR, and they had times they went through where they were terrible at new acquisition, but that 120% NRR just powers them through. So if you can get to that high NRR and happy customers, my advice is it's up to you as founders. It's up to you if you want to push through the pain, if you want to push through the A4 note on the fridge that Roy left up, if you want to do it, because no one can stop you with great founders and high NRR. No one can stop you. And you get to 20, 30, 40 million ARR in SaaS, and if you're efficient, if you're burning nothing, you will get good M&A offers. Every SaaS company I know of that gets to 30, 40 million that is profitable or cash flow neutral, someone wants to buy it because they're going to miss the quarter. Someone out there, so it may not be Monday, but some public company or company about to go public would love an extra 30, 40 million of ARR to bolt onto their company. It's happening left and right today as the people are thinking about IPOing again. So a rambling answer of high NRR, great co-founders, it's up to you. You cannot be stopped if you don't want to be stopped.
My tip, first of all, I agree with Jason. SaaS compounds and it takes time, but once it happens, it's just magic. So I totally agree with Jason. My tip will be everything that you want to measure and eventually become good at, start measuring it today and start improving it today. You want to have great cash flow, start measuring that, start improving that. You want to improve your NDR. It's not magic. Put somebody there to analyze churn. Put somebody to see what make companies leave. Create new upsell opportunities. It sounds obvious, but it's not. Sometimes you feel like this is your company destiny and you're stuck with it, but it's not. If you start measuring and work towards improving it, it's just going to happen.
Yeah. I'm going to add to what Eran said and say that the journey has never been easy for us. It looks maybe we're successful, but it was always tough. And we didn't really have a good NRR in the beginning because it was very small customers and we kept improving the product all the time. But we looked, to Eran's point, we looked at the metric and we saw where the problems were. And we added the sales team. We didn't have that in the beginning. We improved the product. We went after larger customers. So we did everything once we saw where the problems were. And, we were adamant about improving things all the time. So it's not about nailing it from day one. It's about persisting with the measurement. And then it becomes successful. And it's never easy. It's never easy.
Okay, I think we can end with that. So, Jason, thank you so much again for being here with us. True pleasure.
Yes, thanks for having me, you guys. It was great.
And
thank you so much.
Eran. Thank you for listening.